Let's talk about some of the pros and cons for some property strategies, and we'll make a pros and cons list. Nothing beats a good old list. So get your pen and your notepad or your notebook or your tablet ready and start listing down the advantages and disadvantages of various property strategies. So let's get right into it. To the average Joe, not the killer kind, what do the words property investment actually mean? In very simple terms, it means renting out a property that you've purchased or selling a property that you've purchased for a profit, and in between you might have to refurbish it. But sorry to burst your bubble, it's not that easy ever, is it? Now there are a number of different investment approaches and strategies to choose from, and it can be a minefield if you don't know where to start, and some people go into overwhelm, and that's understandable too. Every approach, from buy and hold or buy to let to fix and flip and everything in between, has certain benefits, upsides, downsides, advantages, disadvantages that you ought to consider. First up, flipping. Let's look at the benefits. Number one, in my view, is profit potential. Successful house flipping can lead to substantial profits in a relatively short period of time, especially in a rising market or when strategic renovations increase a property's value, or you buy very, very cheaply and keep the cost down. Second up, property expertise. House flipping allows an individual to gain valuable experience in investing property, property renovations, market analysis, working with builders, contractors, subcontractors, possibly a QS depending on the size of the deal. So it enhances your enhances your skill set. Third up, hands-on creativity. Flippers have the opportunity to showcase their creativity and design skills by transforming outdated or distressed properties into attractive and more lucrative modern spaces. Number four, quick returns. Compared to the longer term strategies like buy to let, house flipping can offer faster returns, allowing investors and developers to reinvest their profits in further projects or to make more money and take more money for themselves. Number five, market stimulation. By revitalizing and improving properties, house flippers can contribute to the overall improvement of a neighborhood and community and stimulate local property markets, including employment and everything else that comes with it. Profit all at once. I love that. When you sell a property, you get all your profits at the same time, because you've obviously realized a gain if you've made a gain, and hopefully you will do. Let's look at some of the downsides. Number one, financial risk. House flipping involves significant financial risk and financial analysis because there's quite a few moving parts, which includes acquisition costs, refurbishment expenses and the time taken to do that, market fluctuations that could lead to selling at a loss, interest rates and the cost of borrowing. All of those things are important. Second up, time and effort. The process of flipping a house can be time consuming and demanding and costly, and there's a need for careful planning, project management and coordination of contractors or subcontractors, and that's not that easy unless you're experienced. And don't leave it to somebody else and say, here you go, fix everything up. It could end up in tears. So you've got to be you got to have your finger on the pulse. Next up, unforeseen issues. Refurbishment projects often uncover unexpected problems or repairs, increasing expenses and potentially impacting the projected profit margin. And jobs sometimes take longer than they ought to, so you want to make sure you address that. Market volatility. Flipping success is closely tied to the property market, and a downturn could lead to property taking longer to sell or selling at a lower price than you anticipated, and your costs could escalate, especially if you've got bridging finance. Competition. The popularity of house flipping has led to increased competition, making it more challenging to find suitable properties at favorable prices because there's so many people jumping on the bandwagon. My favorite one, tax implications. Profits from house flipping are subject to income tax or corporation tax, so you need to make sure that you are planning in advance in terms of your structure and the shareholders and employees and who the profits go to make sure you are tax efficient. Next up is lack of experience. Inexperienced flippers may underestimate costs, overestimate potential profits, take longer to do a particular job, or make poor investment choices leading to a financial loss, and we don't want that. But what makes a property flip successful? To be successful in house flipping, you need to conduct thorough research and have a solid understanding of the local property market and accurately assess potential risks and rewards through proper budgeting, contingency planning, and careful execution of refurbishment are vital, in my opinion, for managing the challenges associated with this investment strategy. I believe property flipping's suitability as an investment strategy ultimately relies on your objectives, financial situation, risk appetite, experience, expertise, knowledge, and the ability to deliver and execute. Successful flippers often have a keen sense of value and a thorough grasp of the regional property market. Now let's talk basics. By basics, I mean buy-to-lets, so bread and butter stuff. They come with many benefits and is therefore an ideal investment strategy, especially if you like low to potentially minimal risk. The benefits of buy-to-let, number one, of course, is rental income. Buy-to-let properties offer a reliable source of rental income as long as obviously a property has a tenant, and it provides you with steady cash flow as the owner of a property, especially if the property is located in a high demand rental area. According to homelet.co.uk's rental index, the average rent price in the UK for June 2023, so pretty much hot off the press, is £1,229, excluding London. The UK average is now £1,027 per calendar month. Every region has seen an annual increase in rent, with Scotland showing the largest, which is an increase of 15.8% since June 2022 to £940 per calendar month. The North East is the cheapest area to rent in the UK at just £625 per month. Next up, long-term appreciation. Historically, the UK property market values have appreciated over the long term, allowing investors to build equity and potentially benefit from capital appreciation. However, this should never be the sole reason to buy a property, because cash is king and cash flow, is more important than capital appreciation in my view. You also want to be thinking about property diversification. Property investing can serve as a diversification strategy, spreading risk across different asset classes and potentially providing a hedge against inflation to some extent, as long as you're spread over a number of strategies. Leverage is one of the most important words in property and in business, and it's as important in buy-to-let. Property investing allows investors to leverage their capital by using some kind of a mortgage to purchase a property, enabling them to control a more substantial asset with a smaller upfront investment, which is usually their deposit. Let's look at tax very quickly. In the UK, landlords can benefit from tax deductions such as mortgage interest if they have a limited company or if they're a basic rate taxpayer. Otherwise, you've got Section 24, which comes into effect. Then you've got maintenance costs that you can claim, other allowable expenses to reduce your burden, and you ought to get to know about what all those allowable expenses are, because there's lots of them. Property demand is important. The demand for rental properties remains strong in certain areas, particularly in cities with a high population of students, young professionals, or areas experiencing strong economic growth. Some of the downsides of buy-to-let: stamp duty and taxes. High stamp duty costs, or an increase in stamp duty costs over the years, and the recent changes to tax relief on mortgage interest have reduced the profitability of buy-to-let investments for a number of landlords. Regulations. Successive governments in the UK have introduced various regulations for landlords, including minimum energy efficiency standards and mandatory licensing, which can increase costs and is an admin burden. Void periods. Nobody likes void periods. There is a risk of void periods where a property remains unoccupied between tenants, leading to a temporary loss of rental income, which may lead to rental losses. Maintenance costs. Landlords are responsible for property maintenance, repairs, renewals, improvements, which can be costly depending on what needs doing, especially if there are unexpected issues. So I would say to you, spend money on maintenance and repairs regularly to keep a property up to date so that it doesn't become worse and cost you more money, and it's right that we offer high standard properties to our tenants. Interest rate risks, we've seen a lot of that over the last 12 months. Fluctuations in interest rates can and will impact mortgage repayments unless you're on a fixed term deal, and this is going to obviously affect your cash flow, especially if you have to refinance and the rates higher, and this can be very significant, as buy-to-let landlords have seen over the last 12 months. Tenant issues. Dealing with problematic tenants, late payments or property damage can be stressful, time consuming, costly for landlords. Market volatility is something which we don't control, but we need to be aware of. Like any investment, the property market is subject to fluctuations, and property values may not always increase as expected. So don't base your model purely on property prices going up every single year, because what goes up must come down. Liquidity. Like any property investment strategy, the cash you might have tied up in a deal is not available for quick access, and buy-to-let investments can provide a reliable income stream and potential capital growth, but they also come with risks and challenges related to regulations, and if your cash is tied in, until you refinance or sell, you won't realize that cash. So I believe it's crucial for property investors to thoroughly research the market, assess their financial capacity, consider the long-term implications before venturing into buy-to-let property deals. Importantly, seeking professional advice from experts, tax advisors, lawyers, etc., surveyors, property builders is beneficial, and it's going to help you make better decisions. Don't you just hate commercials when they interrupt your show? Well, the commercial I'm about to talk about is quite lovable. Building or land utilized for commercial purposes is referred to as commercial to residential conversions. This can include workplaces like offices, retail stores, warehouses, among other types of property. Don't you just hate it when commercials interrupt a good show or a movie? Well, the commercial I'm about to talk about is quite lovable in my view. Buildings or land utilized for commercial purposes is referred to as commercial property. This can include workplaces like offices, retail stores, warehouses, among many others. Let's look at some of the benefits of commercial properties. Regular rental income. Commercial properties typically offer higher rental yields compared to residential properties, especially if you buy well and you're able to split a property and add value and have more than one tenant. Longer lease arrangements as opposed to ASTs. Generally you're renting out to businesses, so you can reference them and see that they are able to pay you rent regularly. Tenant stability. Businesses often sign longer term leases, which can lead to more stable tenancy compared to residential properties where tenants may come and go, and if you've got a longer lease, you could and should increase the value of a property as well, especially if you've got upward rent reviews. Fewer legal restrictions. Commercial properties may have fewer legal restrictions and regulations compared to residential properties, providing more flexibility for a landlord and potentially lower compliance costs. Asset appreciation. Well located, well maintained commercial properties that have a decent tenant with a decent lease, provide a good potential for capital appreciation over time, which can lead to increased property values. Tenant improvements. In some cases, commercial tenants may be willing to invest in property improvements themselves to suit their business needs, reducing a landlord's expenditure. And as a landlord, if you invest that money, then when you get the property back, make sure you go through the dilapidations and get it back in the condition that you have wanted it. But generally speaking, you'll pass on the costs, especially the repairs, maintenance, etc., to the tenant, unlike residential buy-to-let. Some of the downsides. Higher entry costs. Commercial properties generally have higher purchase costs and cost more to buy, generally speaking. Every area is different though, but they do, which means you may need more money in terms of purchasing a property to fund a deposit. Risk of a property being empty. Unlike residential properties, which can have a broader pool of potential tenants, commercial properties have a much smaller pool, so you need to be aware of that. And then if a property is empty and it's been empty for a number of months, you'll have to pay business rates too, so be mindful of that. Market sensitivity. Commercial property values can be sensitive to changes in economic conditions and market demands. A downturn in the economy could lead to reduced rental income because a tenant may want a discount like we saw during COVID, and a property devaluation. Next up is greater responsibility. Commercial property landlords often have more responsibilities, including maintaining the building structure and integrity, compliance with safety regulations, although you can pass some of those on to a tenant, and managing utility systems depending on how many tenants you have. Longer leases. While longer leases provide tenant stability, they may also limit the landlord's ability to adjust rental rates to keep up with inflation or market trends, unless you have it very clearly in the lease in terms of how frequently you're going to review rent. Business risk. If a commercial property is specialized for a particular industry, the investment becomes reliant on the success and stability of that particular industry, i.e. you may have a bank and your business property set up for a bank, and if the bank vacates, then you'll be waiting for another bank, and banks are shutting them down at the minute, so that might not be a good one. Next up, complex legal matters. Commercial leases can be more complex and require legal expertise, potentially resulting in higher legal costs for landlords unless you're able to pass that on to a tenant. Before investing in a commercial buy-to-let property, it's crucial to conduct thorough research, seek professional advice, and assess your risk tolerance and financial capabilities. Each property and location will have unique factors that can significantly impact the performance of your investment. Time to make this a bit more entertaining. Honestly, this form of property investment is the best thing to happen to anyone who enjoys watching chaos ensue.
Some men just want to watch the world burn.
And that is HMOs, houses in multiple occupation. This is a property strategy where 3 or more strangers live under the same roof and share common facilities. Because why not? Let's look at some of the benefits. Higher rental yields. One of the main advantages of investing in an HMO is the potential for higher rental income compared to a traditional buy-to-let property, because you've got 3 tenants as opposed to 1, so the amount that those 3 pay will amount to more than what 1 pays you. With multiple tenants paying rent, the overall rental income can be and will be significantly higher, which is obviously going to lead to better cash flow and higher rate of return on your investment. Lower risk of void periods. In an HMO, even if one tenant moves out, the other tenants continue paying rent, reducing the risk of void periods for the entire property, where no rental income is generated at all. And it's easier to replace one tenant for a part of a house than it is to get a tenant for an entire house. So with having HMOs, it usually provides you with more stable income as a landlord. Diversification. HMOs can offer diversification within a single property. With multiple tenants, you are less reliant on a single tenant, reducing the impact of individual tenant issues on your overall rental income. Some of the downsides: increased regulation. HMOs are subject to more stringent regulations in the UK compared to a standard buy-to-let property. These regulations cover safety standards, licensing requirements, and management responsibilities. Compliance with these regulations can be time-consuming and costly, so go into it with your eyes open. Next up, initial setup costs. Converting a property from a standard residential buy-to-let into an HMO can be expensive. You may need to make significant modifications to a property to meet safety and licensing standards, including fire safety measures, which are obviously important, and sufficient amenities for multiple tenants. Higher management demands. Managing an HMO can be more time consuming, and usually is more time consuming, and that's one of the reasons why I don't like it. And it can be demanding compared to a traditional rental property, because if you've got 3 tenants living in a house compared to 1, you'll have 3 lots of problems as opposed to 1 lot of problems. Dealing with multiple tenants, handling tenant turnover, and ensuring property maintenance is up to date can require time and money. Increased tenant turnover. HMOs often have higher tenant turnover due to the nature of shared living accommodation. Constantly finding new tenants can lead to more administrative work and potential void periods between tenancies. Market saturation. In some areas, there may be oversupply of HMOs, which could result in increased competition and potentially affect rental yields. Before investing in an HMO, I believe it's crucial for you to conduct thorough market research and due diligence to understand the local demand, competition, potential risks involved, so on and so forth. Also, consulting with experts or a property investment specialist can help you make better informed choices so that you meet your goals and objectives. Moving on to something a little different. A property that is rented out by the night for vacations or business use is known as serviced accommodation, and I like this strategy. Some of the benefits: potential for higher rental yields or income. Serviced accommodation often commands higher rental yields compared to traditional longer term rentals like buy-to-let due to the short nature and premium pricing for renting rooms by the night as opposed to a 6-month AST. And it works incredibly well, especially in busy commercial or tourist areas. Flexibility and higher rental rates. Serviced accommodation can be rented out on a daily or weekly basis, allowing investors to adapt to market demands and maximize revenue during peak seasons. Lower void periods, if void is the right word to use, vacant period I'd say. Short-term rentals often experience lower vacancy rates as they attract tourists, business travelers and individuals seeking temporary accommodation as long as it's in the right area. Diversification. Investing in serviced accommodation can provide a diversified property portfolio, reducing the risks associated with relying solely on long-term residential buy-to-let properties. Let's look at some of the downsides. Intensive management or extensive management. Serviced accommodation requires more hands-on management due to frequent guest turnover, cleaning, maintenance, etc. Think bed and breakfast. This can be time consuming and may require hiring a property management company, which can reduce your margins, or you do the work yourself, which will take you away from doing other work like finding more deals. Next up, regulatory challenges. The short-term rental market is subject to various regulations and restrictions which can differ between cities and regions. Compliance with local laws and national laws is essential and may impact the viability of your investment in terms of costs and in terms of what you can and can't do. Seasonal and economic fluctuations. The demand for serviced accommodation can be highly dependent on seasonal factors and economic conditions, making it more susceptible to downturns or unexpected shifts in tourism and business travel. Furnishing and upkeep costs. Setting up a serviced accommodation business or unit with furnishings and amenities can be and is costly, because if you want to make it nice, you got to spend money. If you spend money and you make it nice, you get more people booking rooms by the night. Additionally, the need for regular upkeep and refurbishment costs can add to the ongoing costs, and you just need to factor that into your calculations. Increased competition. The popularity of short-term rentals has led to increased competition, making it crucial for investors to differentiate their properties and offer a unique experience to attract more guests. Limited rental income during off-peak periods. During low demand periods, it may be challenging to achieve the same rental income levels, potentially impacting cash flow, and you may need to get surplus cash from elsewhere to fund all your costs. That won't always happen, but you need to be aware of that. Whatever course you select, make sure you take your time and thoroughly research and analyze the advantages, disadvantages, upsides, downsides of any particular strategy, and your choice will depend on whatever outcome you require and your objectives and your situation.